So in our previous session, we did introduce audit risk. We did introduce audit risk. So let's start with a quick recap of what we were talking about in the last session. So I will start with a quick recap. Just confirm if my screen is showing from your side. Confirm with me if my screen is showing from your side, please. Okay, so let's have a quick recap of what we were dealing with in the last session. So in our last session, we did talk about the audit documentation. We did also talk about audit risk. So audit risk, we said this is the risk that the auditor, we hire the auditor to give us their opinion. Then they give us a wrong opinion. So as an auditor, you are supposed to be careful not to be affected by audit risk. You are supposed to make sure you do carry out your procedures and avoid audit risk. Avoid giving a wrong opinion when the financial statements are materially misstated. What can cause an auditor to give a wrong opinion? It can be as a result of the detection risk. Detection risk is all down to the auditor. If the auditor has used the wrong procedures, the auditor has used the wrong team, the auditor has audited the wrong areas. So that's detection risk. It's all down to the auditor, what the auditor did to get the evidence. So audit risk can be as a result of detection risk. It can be as a result of inherent risk. Inherent risk, this is the risk associated with the nature of the business. So the inherent risk is the risk associated with the nature of the business. Then we also have the control risk. The control risk is associated with the entity's controls. Because as an auditor, in some cases, I will place reliance on the entity systems. So I came to conduct the audit, and I had to rely on the systems of the entity. So if I place a reliance on the systems of the client that have weaknesses in them, that is control risk. So it's more like you are coming to audit a company, then you hear that in this company, there are cameras, there's a guard who is looking after this property, and we are told there are cameras that are showing all the angles of the warehouse, and at the same time, we are also told there are alarm systems in place. And as an auditor, you then say, so why should I carry out a detailed check of whether all items are there? Because with these strong control systems, there are less chances that someone can be able to penetrate and steal and not get noticed. So as an auditor, I can rely on the control system without knowing that it is the guard is actually one of the people that are involved. And the cameras, sometimes there won't be electricity, and the cameras and alarm systems will be off. So I relied on the control system of the client, which had its own weaknesses. So the system of the client failed to detect where there were errors. And as an auditor, I did not check, I simply relied on the system of the client. So we also did talk about how you find the audit risk. So a question will say, identify the audit risk and come up with the auditor's response. So you'll be required to identify the audit risk and come up with the auditor's responses. So if you are identifying the audit risk, if you are identifying the audit risk, it means you are identifying a situation given in the question that if the auditor is not careful enough about, they are likely to give a wrong opinion. So they'll give you a case, and from that case, you are supposed to pick a situation that indicates that if the auditor is not careful, they might give a wrong opinion. Then after we've identified the audit risk, we are also supposed to come up with the auditor's responses. The response tells us what the auditor should do so that they are not, so that they can be able to identify the errors and fraud. So how should the auditor gather evidence to confirm that everything has been dealt with properly? So that is the auditor's responses. So the response tells us how should the auditor gather evidence. So if the question says identify the audit risk, what steps are you going to take? So if the question says identify the audit risk, we are going to need, number one, a risk indicator. So the first thing is to get a risk indicator. The next step is to tell us the accounting treatment. That is, if the risk involves the accounting treatment, then also we need to know the impact in the financial statements. So it's very important to tell us if the auditor, if this area is a risk, what is its effect in the financial statements? So we want to know whether it will result in assets being overstated, assets being understated, or assets being misstated. So I think if you want detailed knowledge regarding this, you can go back to our previous session and look at that. So now let's proceed from where we were. So the last thing we were doing, I was looking at the key standards that you must have an understanding on, because you will realize that there is a link between audit and assurance and the F7. So the link that is there is an auditor is supposed to come and verify that the standards have been properly applied. So it becomes a challenge for you as an auditor to verify that something has been done the proper way when you actually don't know the proper way. So it's also important that you know the standards, because as you are going to be auditing, you need to be able to know whether, you need to be able to know the standards first. So we did talk about IAS 2, which is a standard on inventory valuation. Of course, the detail part of IAS 2, you get it in when you're doing F7. But I did mention that the issue that normally affects us in auditing is how the inventory was valued. So if you're an auditor and you are told that they valued inventory using this method, you need to watch out. Is the method the lower of cost and net realizable value? There is a common danger of valuing inventory at a price which is not the lower of the cost and net realizable value, thereby violating the requirements of IAS 2. So you need to consider whether the price that they have valued, is it in line with the requirements for IAS 2. Then besides that, we can also look at, besides that, we have IAS 7. IAS 7, we did talk about this one. It tells us how we classify the cash flows that we receive in the business. So, data. Yeah, it repeated. Okay, just a moment, Tim. Just order. And yagambo connector. Mungu akuisa ba reception apo tutekwanisa kuconnecta kuno batudaya connecta. Ngwesa bota izo muna absofika inunda. Okay, sorry for the disturbance. Tadela. Say Tadela. Okay, let's proceed. So, IAS 7, I was saying the IAS 7, the standard tells us how we are supposed to account for the cash flow, the incomes we receive from cash flows. So we need to classify these cash receipts into either being from operations, the receipts as either being from investments and being from financing activities. So the key risk here is a misclassification of the cash flows. Maybe where the profit from disposal is treated as an investing activity. So that could be a risk there if we are preparing the cash flow statement. Then changes in accounting policy and accounting estimates. So changes in accounting policy and changes in accounting estimates. These are also a crucial area to watch out for. So for the changes in accounting policy and changes in accounting estimate, the key risk that is there is that the company can have a change in an accounting estimate, but that change can be treated as if it's the policy that is changed. So the company can just change an estimate, yet it then be treated as a change in policy or the other way around. So if we change depreciation, it's an estimate. So we are estimating each, the change in the estimate, it requires, it's more like, sorry, the change in the provision for doubtful debts. We estimate each year those that we think are not going to pay the amount due. So as we estimate those that are not going to be able to meet their obligations, we don't need to adjust the prior year financial statements. So if it's a change in estimate, we make a retrospective adjustment. Then if it's a change in the policies of the company, if it is the firm's policy that we are changing, we make a retrospective adjustment. Then let's move on. Let's move on. Then besides there, we have the next standard IAS 10, which also tells us how we account for events after the reporting period. So for the events after the reporting period, they can either be classified as adjusting events or non-adjusting events. So the key risk associated with IAS 10 is that they can be an adjusting event which was not accounted for. So there can be an event discovered after the financial year, which has not yet been adjusted, because the auditors are going to audit after the year end. So during the audit period, if there is an event that is showing, but this event should have been recorded last year, so it's like the auditors have started auditing and it's now 10 January. And they realized that there was an error which was made in the financial statements which they are auditing. If this one, if the error is pertaining to the previous year financial statements, they should request that the adjustment they made. So if they fail to detect the adjusting events, that can also result in audit risk. So events after the reporting period, we need to ensure as auditors that the adjusting events have been adjusted and the non-adjusting events have not been adjusted. But for non-adjusting events with significant impact, there's a danger that the disclosures for these may be missing. So we need to ensure that the non-adjusting events that needs to be disclosed have been disclosed. That is for non-adjusting events with significant impact. Now, let's get to today's issues. So these are part and parcel of what we discussed in the last session. Now, let's continue with these standards. So regarding the standards, I did mention last time that when you are identifying an audit risk, I gave an example, I think, here. KD Limited entered into a 10-year lease agreement to use the property of ABC Limited. According to IFRS 16, the lease must be split. The lease must be split into current and non-current liabilities and recorded in the statement of financial position. So the lease must be split into current and non-current. So what am I doing here? This is application of what the standard says. So you need to be well-versed with what the standard says and also the potential errors. Like in this particular case, the potential error is failing to account for the lease, splitting it into current and non-current. So I was going through the standards, telling you some of the common errors which are made that as an auditor you should watch out for. And remember, if you're saying this situation is a risk, we are not saying this is what they did. We are saying it is a possibility that they could have done that. If they did that, there is a problem. So as an auditor, if we hand over the financial statements to you, you have to check areas where you think there is a risk. So if they tell you that the company, there was an event which took place after the year end, need to check, is it not an adjusting event? Did they account for it? There's a risk there. If they tell you that there was a change in the way that we were accounting, check, did this change not affect the financials? Did they properly account for that change? If they tell you inventory was valued this way, so the moment they mention inventory, in your mind, think of what could go wrong with inventory. The moment they mention about PPE, think of, according to IS 16, what problem could they have met here? Then from IS 10, let's move on. So IAS 10, then we move to SOS 10, then we move on to the key standards that let's move to IS 16. Because we have IAS 11, but IS 12, sorry, income taxes, but don't wait. Yes, everything. All right, it's fine. IAS 16. IAS 16. So for IAS 16, that's accounting for property, plant, and equipment. Property, plant, and equipment. Accounting for property, plant, and equipment. So which are the key issues to watch out for? So under IAS 16, remember initially the assets are supposed to be recorded at cost. That is what the standard requires. We initially recorded cost. So if they mention that we acquired assets, watch out. How did they record this asset? Did they initially record it at cost or not? So that is the key risk, that we might not have initially recorded the asset at cost. So the asset might not have been recorded at cost. Remember, a risk, we are saying this is a potential problem, not what actually took place. The other issue is that if we are using the revaluation model, so if we are using the revaluation model, there is need to ensure that the person who is doing the revaluation is someone who is qualified. So the person who is doing the revaluation, they must be qualified in the area. So there is a risk that the revaluation was carried out by someone who is not qualified. The revaluation was carried out by someone who is not qualified. The revaluation was carried out by someone who is not qualified. My signal strength is low. Just confirm those online. Can you hear me?
We can hear you, sir.
Okay. So if there was revaluation of PPE, we need to confirm if we are auditors, we might need to review the paperwork of the person who carried out the revaluation to see, are they a competent person? Otherwise, the assets could be overvalued. Then also, remember, if we have non-current assets, if we use the revaluation method, there is also a risk that the revaluation gain was taken to profit and loss, while it is not supposed to. Revaluation gain might have been taken to profit and loss, of which we are not supposed to take the revaluation gain to profit and loss. We take it to other comprehensive income. So there's a potential problem there. Also, if the asset has been acquired, then, but this one is too basic, unless there's an indicator, this one is not a wise move. There's a risk also that maybe the depreciation might not have been calculated. If maybe they say that the asset was bought, but it was not being used, then we can say there's a risk that they might not have depreciated the asset. Remember, depreciation is calculated from the debt. Control is gain. From the debt, we are able to use the asset. Not from the debt, we started using the asset, but from the date we are in control of the asset. So we can say that there is a risk, there is a risk or failure to account for depreciation. But this one is a tricky one. It normally applies provided we are saying there's a case given, because we can't look at a finance person who is experienced in the field failing to account for depreciation, unless there is an indicator that's showing you to know there is a possibility this can happen. So we have a problem of failing to account for depreciation, maybe in the case that the asset has been bought, but it's not being used. Besides that, also, what can we talk about? We can also have a case where the PPE, I think we can add on if I come across, if I remember anything that can be of essence there. So let's move on from IAS 16. We can also get to the next standard. I'm just summarizing the key standards, what you need to watch out for generally. But these are not all the areas. The list is long. I'm just touching on the key areas I can remember. IAS 20, this tells us how we account for government grants. Accounting for government grants. So if you are accounting for government grants, remember the grant, it can be a revenue or a capital grant. So if the grant that you have received from the government is a revenue grant, it's supposed to be netted off against the expenses. So that one is normally easy, where you just take the grant that you have received, you use it to subtract the expense. So if you're supposed to pay expenses of $100, you receive a grant of 20, you record expenses of 80. But the capital grant now, especially if the capital grant is using the deferred income method, that one, it has a potential problem. So capital grant using the deferred income method. If the organization has a capital grant using and is accounted and accounting for it using the deferred income method, so the problem with this one, if we are using the deferred income method, the problem is that we might fail to split the liability again. So there is a common problem of failure to account for the grant as being current and non-current. So there's a risk that the grant might not be split. There is a risk that the grant may not be split into current and non-current. So there's a risk that the grant was just recorded as either a non-current liability or a current liability. It was not split into current and non-current. That can be common because this method has a number of stages. So there can be an issue with accounting for the grant there. So I'm not saying that's the only issue, but that's something that you can find maybe more oftenly regarding accounting for the grant. Then also we have IAS 21. So foreign currency transactions. So the problem here could be determining the rate to use. determining the rate to use. What could be the key risk? The risk could be the use of the wrong rate, or besides using the wrong rate, we can also have failure to account for foreign exchange gains and losses. So the key risks are failure to account for foreign exchange gains and losses. And so we can fail to account for foreign exchange gain or losses and so failure to account for foreign exchange gains and losses and the use of the wrong rate, e.g. using the spot rate instead of the historical rate. Remember, for foreign exchange transactions, if there are transactions that occur during the year, we use the average rate. Transactions that occur many times or regularly during the year, like income statement transactions. These ones, you use the average rate. Then monetary transactions, we use the spot rate. Non-monetary transactions, we use the historical rate. So there is a problem regarding failure to account for it. We are going to do IS 21 for F7. So I'm sure regarding the treatment, you'll be having knowledge on that. Then let's move on. Besides IAS 21, we have IAS 23. So it means if you are doing F8, you need to know F7 as well. IAS 23 is a standard on borrowing costs. So as an organization, we can borrow. So as an organization, we can borrow money to finance the construction of fixed assets. So the borrowing cost, the cost of borrowing in order to finance the construction of fixed assets, some of the costs are capitalized and some of them are treated as expenses. What is the common risk here? The common risk is including borrowing costs that are supposed to be expensed as capital costs, or including borrowing costs that are supposed to be capitalized in expenses. So the risk is including borrowing costs that are supposed to be capitalized, including borrowing costs that are supposed to be capitalized in expenses, including borrowing costs that are supposed to be capitalized in expenses, and including, or we can say, or vice versa. So the opposite is true as well. We can take some of the borrowing costs that were supposed to be treated as expenses. So that the first risk is treating borrowing costs that are supposed to be capitalized in expenses, or treating those that are supposed to be expenses, we treat them as capital. Or those that are supposed to be capital, we treat them as expenses. So that is the issue regarding the borrowing cost. Also, remember, we can borrow money. After we've borrowed money, we can invest it. So we can also have a challenge of failure to reduce the borrowing costs capitalized after the amount borrowed was reinvested. So if you borrow money and you invest it back in, or you borrow money to construct a fixed asset, and that money you have borrowed, if you give it to someone else as well, and they give you interest. We said in F7, we said that the amount you have received should reduce the borrowing cost. So you got 100,000 from the bank, and you decided, okay, I'm going to use 20,000 now, then the other 8,000, sorry, I'm going to use 20,000 now, then the other 20,000 I will need it in November. Then you can maybe give it to someone and earn an interest from it for that period when you're not going to be using it. So that one is a benefit you are getting from the money you have borrowed. So when you are paying interest, you are going to incur borrowing costs, but the burden that you're going to incur will be less because you have recovered part of the interest when you also lend out the money. So this one, we are not going to be required to know the standard in detail or to explain the standard in detail. Of course, you must know it, but explaining it, no. Because what we just need to know is there a problem? So if they tell you this is how they recorded the borrowing cost, is there a problem with what they did? Now let's move on. IAS, from the IASs, I think let's move to IAS, the key one, IAS 36. Or maybe before 36, we also have 33, but for 33, let's move to 36. So IAS 36 talks about impairment of assets. Impairment of assets. So for the impairment of assets, an asset, remember, is impaired when the carrying amount we are reporting in the books is different from what we can get if we are to sell the asset. So the carrying amount is higher than the recoverable amount. So what is the risk here? We should always, when there is an indicator for impairment, we are supposed to carry out an impairment review. So the first problem is the indicator is there, but we have not carried out an impairment review. So the first problem is that the firm may not have carried out an impairment review. The firm may not have carried out an impairment review, even though there is an indicator. Even though there is an indicator for impairment. So as long as there is an indicator for impairment, there is a danger that they might not have carried out an impairment review as requested by IAS 36. So indicators of impairment review, maybe the asset is now partly damaged, maybe the use of the asset has changed. So those are some among the list of the indicators. Okay, then besides the issue of not carrying out an impairment review, the other problem that we might also face for IAS 36 is failure to transfer the impairment loss to profit and loss. Impairment loss to the income statement. So failure to transfer the impairment loss to the income statement. Failure to transfer the impairment loss to the income statement. So failure to transfer the impairment loss to the income statement. The impairment loss is supposed to be transferred as an expense. And also what could be the other issue here? I think those are the issues that we might come across, but there can be other issues as well. I'm just highlighting the issues that are coming into my mind, maybe regarding these standards, what you need to watch out for. So from IAS 36, we have IAS 37. So we need to create provisions. So as a result of legal, or as a result of, we can have an obligation as a result of our conduct or as a result of the law. So the organization needs to create provisions. So there's a danger that a provision was supposed to be created, but it was not created. Like in the case that our customers that buy goods from us, we normally provide a discount. So we normally provide room for them to return the goods that they've bought if they are not satisfied. So if we give them room that if they are not satisfied, they can return the goods. We need to create an estimate each and every time of the customers that will return the goods back. So there's a risk that provision, there is a risk that a provision was not created. Account for the liabilities. So we need to create a provision if there are chances, if it's probable that they are going to return. So they're going to return the goods back. After you've sold, you create a provision for refunds. So we can also have a case where we are going to maybe stop a certain department. So if a certain department is going to be stopped, or a number of employees are going to be stopped, then we need a provision for redundancy. So when employees contracts are prematurely terminated, you may be required to pay them a redundancy package. So if you are planning to make employees redundant, there is need to create a provision for redundancy. So also there's a risk of not creating a provision for redundancy. Not creating for a provision for employee redundancy. Not creating a provision for employee redundancy. So that is to be connected to the case. For you to say so, the question should have mentioned that we are going to make, the company is planning to make to make certain employees redundant. Maybe they are planning to introduce a machine. So once they are planning to introduce a machine, that can result in some employees being made redundant. So you then say there's a risk that the plan has been made to replace the employees, but a provision for redundancy has not been created, resulting in understatement of the provisions. Then IAS 38, intangible non-current assets. So for intangible non-current assets, remember these are assets without a physical form. So for intangible non-current assets, which are the key risks here? The first key risk we can talk about is amortization cost. So remember, intangible assets, they're not depreciated, but they are amortized. So failure to amortize, especially if it's the first intangible asset that we have, failure to amortize the intangible asset. Then also using the amortization method on intangible assets that have an indefinite life. Remember, if intangible assets have an indefinite life, you don't amortize them, but you don't amortize them, but you review for impairment annually. So using amortization method on intangible assets, with an indefinite life. Using intangible assets, using amortization method on intangible assets with an indefinite life. Failure to test intangible assets. These are the common problems that can be there. Failure to test the intangible assets. With an indefinite life. For impairment. Failure to test for impairment annually. Failure to test for impairment annually. So we can be told that the intangible assets, there is a license that we receive. And we are going to be using this for a very long period of time, and the time period has not been defined. So that intangible non-current asset, we should test it for impairment annually. Can I just have a glass of water? I will be just now. Okay, let's proceed. So IS 38 is a standard that tells us how we account for intangible non-current assets. So you're an auditor, you are given the financial statements of the company, and they're telling you that this company obtained a license to use, but it doesn't know for how long it will benefit from this license. Then to you, you should know this is an intangible non-current asset, but it doesn't have a defined life. So you then say, they will just say that the company obtained a license for an indefinite period. Then they are done. As an auditor, it's you that has to now figure out what could be a problem, what could they have done wrong. Then you dig deep and say, okay, if this is a license and it has an indefinite life, there could be a problem with failure to account for this intangible non-current asset. Since their first time, they might have not tested it for impairment, because you test for impairment annually. Even the question will not say that's what they did not do it. No, you are assuming that they might not have done. Another issue is splitting research and development costs. Treatment of research as development and vice versa. There can be a failure to separate research and development costs. More precisely, we can have also development costs that have been capitalized when they have not met the criteria. Capitalization of development costs when they have not met the criteria. Capitalization of development costs when they have not met the criteria. Capitalization of development costs when they have not met the capitalization criteria. Now let's move on. Besides IAS 38, we have IAS 40. Investment property. We acquire property as a business, and this property has been classified as investment property. So if it's investment property, we need to check the use. Is it being used for rental purposes or for capital appreciation? Because once the property is classified as investment property, it must not be used for private, or it mustn't be used by the owner. It must be for rentals or for capital appreciation. Verify that the use is investment purposes. How do you do that? You can get the lease agreement. Let's get the lease agreement from the tenants to ensure that, in fact, indeed, this property is being used as an investment property. Then also there can be a challenge with accounting for the investment property. The gain in the investment property is not taken to other comprehensive income. It's treated differently from gain in revaluation of PPE. The gain in the value of the investment property, if we are using the revaluation model, the gain in the value of the investment property is taken to profit and loss. So they might have taken it to other comprehensive income. They could have taken the gain to other comprehensive income. Then also we can be told that, or if it's the revaluation model, they should not depreciate the investment property. The other risk is depreciating the investment property. Whilst using script. Okay, the team online, just a moment. Okay, let's proceed. Sorry, I was attending to someone. So IS 40, depreciating the investment property whilst using the revaluation model. The revaluation model for investment property, you don't depreciate the investment property. Depreciating the investment property while it's using the revaluation model. We have IS 41. So all these standards are in detail, we'll cover them in F7. If we haven't already done so. IS 41, that's accounting for biological assets. So we have the biological assets. So for the biological assets, if we are dealing with accounting for the biological assets, remember, a biological asset is accounted for at fair value. But if the fair value cannot be determined, we can use the cost model. So there is a danger in determining the fair value. There is a risk that the wrong fair value can be used. There is also a risk of classification. So for biological asset, you need to separate a biological asset from a bearer plant. A bearer plant, this is an asset that produces, a plant that produces fruits for more than 1 year. If it's maize, you just harvest maize once, that's a biological asset. But if it's now an orange tree, that is called it's now That one, it would be, so we have there's also a problem between, so there's a problem of distinguishing a biological asset from a bearer plant. If it's a bearer plant, you treat it using IAS 16, not IAS 41. You don't record it at fair value, but you will be using the IAS 16 procedures. Then also, once plants have been harvested, we can't use IAS 41, we use IAS 2. So there is also a risk that plants have been harvested. Plants or produce have been harvested. But not valued at the law of cost and net realizable value. We don't value at fair value once it's now produce. If it's now produce, we are now applying IAS 2. So there's a risk that plants have been harvested but not valued at the lower of cost and net realizable value. So plants have been harvested but not recorded at the law of cost and net realizable value. Why should they be treated at the law of cost and net realizable value? Is once they are harvested, they are now part of inventory. Now, besides the IAS, we also have the IFRS standards, the International Financial Reporting Standards. So the IFRS standards, we can start with IFRS 5. Assets held for sale. And discontinued operations. So we have assets held for sale and discontinued operation. Sorry, can I answer this? Yes, hello. Right, Sirugudi. So this is the right time. And listen. That's okay. Told the tower up and bottom lesson. The page on 5. Yeah. Okay, IFRS 5, assets held for sale and discontinued operation. So there's a risk there associated with classification. The asset might be held for sale, yet we keep recording it under non-current assets. If it's now held for sale, it shouldn't be recorded as a non-current asset, but it should be recorded as a current asset. So there's a problem there in most cases, so you need to watch out that they have not also fallen prey of that. So as an auditor, check, did they classify the discontinued operation properly? Then also, sometimes they might remove it from non-current asset, but when the conditions of reclassifying it as a current asset are not met. So you don't just record it as held for sale because you're planning to sell it. You don't just record an asset as held for sale because you're planning to sell it. there must be conditions met. So there's a danger we can record it as held for sale while those conditions have not been met. Then also, the held for sale assets must not be depreciated. So there is also a danger of depreciating held for sale assets. So you are an auditor. You are supposed to have all this in mind. Coming to audit, what could be the problem here and there? Okay, if they tell me that there's an investment property, what could be the problem? Okay, there's a biological asset. Okay, what could be the problem? So they will say identify the risk. You're identifying the potential problems that could be in the case that we have been given. So IFRS 5, assets held for sale and discontinued operations. There is also a danger that the asset is depreciated. Held for sale assets are not depreciated. There is a danger that the held for sale asset was depreciated. They depreciated the asset held for sale. That is the problem that can arise as well. Then, regarding the discontinued operations, remember the profit from discontinued operations must be shown separately. So, there is a risk that the profit from discontinued operations has not been shown separately. So there's a risk that the profit from discontinued operations has not been shown separately. There's a risk that the profit from discontinued operations has not been shown separately. Then let's move on. IFRS 5, the other one, the case standard, we can move to, from IFRS 5, we can move to IFRS 9. So the firm can invest in financial instruments. So the firm can invest in financial instruments. So the financial instruments, they have quite a lot of steps that we need to take. So failure associated with financial instrument, there's a risk of accounting for these financial instruments. So it now depends with which instrument are we dealing with. So this one in general, the risk, because it's an area that is a lot of calculations, the risk is accounting for the instruments. Now it depends on which issues have you been given in the question. Is it an equity instrument? Is it a convertible instrument? Is it an asset? So you need to consider which instrument are we dealing with in the question. So if it is, for example, a convertible instrument. So a convertible instrument, we have to split it into its debt and equity components. So there's a risk that the instrument was not split properly into debt and equity. The convertible instrument has to be split into debt and equity. So there are quite a lot of areas for IFRS 9. You can cover that in when you're doing F7. Then besides IFRS 9, IFRS 10, business combinations, but let's just move to, I think the next one is IFRS 15. This one is a key one, revenue, accounting for revenue. So this is an area which is prone to risk. So this area is prone to risk. There are high chances that revenue of the business may be misstated because the company knows, the directors knows if they overstate revenue, they can overstate profit. If they overstate revenue, then they can easily window-dress their account. So the key risk is early recognition of revenue. There's a potential problem of the directors or managers recognizing revenue before the transaction is completed. Remember, the standard says revenue should be recognized after we have met the performance obligations. So there's a danger of recognizing revenue whilst we have not yet carried out all the performance obligations. So revenue must be recognized after meeting all the performance obligation. Revenue must be recognized after meeting all the performance obligation. So there's a risk that maybe we can enter into a contract which requires us to perform obligations for a period exceeding a year. And we record all the sales in 1 year. If we are required to be doing something that will maybe take 2 years, it means the revenue from that, we need to split it over the 2-year period. If the contract is exceeding a year, it means the revenue must be split as well. So there's a risk of recording revenue, including revenue for next year in this year. And also, if customers make prepayments, there's also a risk of including prepayment in this year's accounts, because the prepayments should be met with the expenses for their period, not this year. We can't include prepayments as revenues for this particular year. If our customers are paying in advance, we don't include that in the current year. So that is the problem associated with revenue. Normally, revenue is used by management as a way of trying to manipulate the profit. They can early recognize revenue. Then the last one, IFRS 16. So leasing. So if you are using property that is not yours, you are required to record the right of use asset. And a lease liability. You are required to record the right of use asset and lease liability. So the problem, number one, can be as a result of failure to account for the right of use asset. Or number two can be this right of use asset must be depreciated, or recording the depreciation from the right of use asset. The lease liability also has a finance cost, so might also face a challenge of failure to account for the finance cost. Failure to account for the finance cost. Of the lease liability. So these are some of the areas that you need to watch out for as an auditor. Remember, if you're an auditor, audit risk, you are digging the financial statements of the client, trying to figure out where could they be errors and mistakes. So having all this in mind, you then need to align with the question. So you don't just start by saying there's a risk that they did not depreciate the right of use asset. Is there anything in the question that is leading us to think that? Is there anything mentioned in the question that you can say, why have you thought like that? So then we are done with the key standards I wanted to mention. Then let's move on. So we said if you're identifying an audit risk, get a case from the question. The case from the question, which is the risk indicator. You tell us how we are supposed to treat the transaction, accounting treatment. Then tell us the impact in the financial statements. The impact in the financial statements. Then on the other hand, we need the auditor's response. So for the auditor to respond, they need to gather evidence. So the topic we are now going to talk about is audit evidence. So for the auditor to be able to respond, they need evidence. The auditor's responses must tell us what should the auditor do to get the evidence. So the responses should tell us what the auditor should do to get evidence. So in order to get evidence, in order to give the right opinion, the evidence must, number one, be relevant. So the auditor's evidence must be relevant. It must be sufficient. So the evidence must be relevant and it must be sufficient. The evidence must be relevant and must be sufficient. If the evidence is relevant, this means that the auditor is going to assist the auditor in getting the answers that the auditor wants. So it might be good evidence, but not relevant to the questions, to the areas that they want. If they want to check whether the right of use asset has been recorded, evidence to do with the revenue might not be relevant. Relevant is a matter of, does the evidence obtained assist the auditor in coming up with a conclusion? Does it assist the auditor in coming up with a conclusion? So being relevant, it means it can assist the auditor coming up with a conclusion. Then the evidence must be sufficient. Sufficient enough to collaborate opinion. It must be enough to assist the auditor in coming up with an opinion. So sometimes we might get the evidence, but it might not be enough. So if the audit evidence is sufficient, it's enough to assist the auditor in coming up with a conclusion. It must be plenty enough to assist the auditor in coming up with the right conclusion. What can affect the relevance or sufficiency of the evidence? It could be, where are we getting this evidence? So we can also add, the source of the evidence may determine its relevance. The source of evidence may determine its relevance. The quantity may determine sufficiency. So how many, or how big is the population and how big is the sample? The quantity, it can also play a role in determining the sufficiency. Okay, so now, so the subheading, audit procedures. So the auditor has to conduct procedures to gather evidence. Audit procedures. So this is where we are going to end today. So we end with the audit procedures. The audit procedures, these are the ways that the auditor is going to use to gather relevant and sufficient evidence. How is the auditor going to gather the evidence? they make use of audit procedures. So for today, let's end here. Then we can resume from there in the next lesson. My team online, thank you so much. I don't know if there is a question before